joining us this morning. We would like to run through an update, and most of you will have read, as it was published last week, the capital raise information for the update. We do want to run through that with you, give you a little bit of detail, context, and then keep as much time as we can for open Q&A. So we welcome all of your questions. Please feel free to put them into the chat as we go. We are recording this, and it will be posted to our investor hub. So obviously, Karen Gilmore, our CFO, on the right-hand side, and I'm Trent Lund, your CEO.
Morning.
Good morning, all. So let's jump in. We'll start with company performance and outlook, and talk a little bit about the capital raising and the intention behind it. I'll dive straight in. I suppose just for those who are new on the call, really just a reminder, we are a RegTech company for regulation technology, so effectively moving regulated transactions, particularly around super, but we focus on compliance from hire all the way through to retire. Superannuation is the market we've really started our position in. We're delighted with the position that that's in right now. And obviously that is because it gave us the greatest reach to customers in the market, in particular, payroll and HR professionals who are our target audience. Purpose of the business, making compliance effortless. The more complex compliance gets out there, the more relevant we are, the harder our job is. But obviously, the more required we are by the market. And we trade off one unified platform. So as we grow and expand into other segments, you will see our cost benefits really start to pay back. I just roll through a reminder to people, and really an understanding of our business. We do talk a lot about super because that is the here and now of our business. It's really our business evolves across 4 segments. So the main segment today is super. We believe there's a very large addressable market, and we've already seen fairly substantive success there. 6 out of 10 of the largest funds use our software in one way or another today. But we are also growing in our footprint, in particular through our MUFG partnership. That reach, we have a little over 5 million contracted users right now, and so a long way towards our 7 million target. Of course, getting them on board, getting them transacting and paying their super is the critical juncture we're at right now. That said, we don't see super stopping at that end. We do see growth. We see growth across other funds. We also see growth as we move into the decumulation phase. Actually, there's been a lot of reporting on that lately in the AFR. So there's a fair bit of conjecture and conversation, but actually Wrkr is very well poised in helping and working with the funds as people move out into decumulation away from accumulation, using the same technology we provide for them. The other segments are critical for us as we move into pay, so wage payment, disbursements, single touch payroll, and through the acquisition of PaidRight, paychecks and pay compliance moments. All of those we actually have fairly substantive experience in. It is really bringing the customer base on first with super to be able to provide those products. And then credentials being the latter segment, we see that as a more lucrative segment, but it really benefits from having infrastructure that is robust, secure and trusted, as opposed to how it's dealt with today, which is through many, many small providers dealing with PII information. That's not as secure. Long-term strategy, of course, is direct to the consumer. And engaging a consumer in their data around their credentials, around their pay and around their super, it opens up the door for benefits, helping them navigate their health wealth into the future. But right now, we're grounded in the present. So I'll let Karen talk a little bit about the performance today, and then we'll jump in to the ramping up of users and also the capital raise.
Thanks, James. And good morning to everyone. Thanks for joining. Just wanted to jump into the quarterly results. the year finished really strong. We had a very strong year in terms of quarter in terms of cash receipts. That was really driven by seeing the funds come in from all the development and implementation that we as Wrkr have done across the MUFG funds. Obviously, we are starting to onboard across Australian Super and Rest. The quarter also saw us bring on the 4 smaller boutique funds, which are Busview, Nest, Legal Super, and Time. So it was great to see that all happen without incident, but to get those people onboarding. Additionally, we had some good cash receipts for our annual license fees across our platform as a service customers, and also with MUFG, there's a component of license fees. So that's what really drove the Q4 cash receipt up $2.5 million from the prior quarter. That then obviously gave us a quite a neutral operating cash position. We've spoken about the fact that we've invested quite a lot of resource into making sure that the implementation goes well across the funds. That's included data migration projects, that's included hypercare support, that's included release management on our feature development, to reduce friction in the platform and onboarding, improve the security posture. There's a lot of fraud in the industry around payments generally, and so making sure that that is as robust as we possibly can be in seeing fraud signals in the market, making sure that they're protected there. Also went live with Payday Super on 1 July, and that came with feature development in terms of the way that super stream changes happened, and also introducing MVP payment method PID. So there was a lot going on in the quarter, and it was really great to see the team working together, achieving the go live with Payday Super. That leads me into the full year. So cash receipts of 18.2 million, our best year on record. So increasing from 9.9 million in FY25. So quite an impressive increase in cash receipts. As I said, a lot of that is implementation and development work. Underlying that is about 10 million, approximately 10 million of ARR that we'll be taking into FY27. The rest is made up of that development and implementation. So now we're just really looking forward to getting all of the employers onboarded, that they start making contributions, which we're definitely seeing, and start to increasing our ARR throughout the year. In terms of our cost base, so we ended up with a negative operating cash flow of 1.6 million over the year, really due to the reasons that I mentioned before, and making sure that we are fully resourced to make this a successful implementation and contract with our partner funds. We had quite a lot of investment in the platform as well in the year, $8 million of capital investment, and really we're seeing some amazing features in the platform. Onboarding, they've taken no time at all for people to get their first contribution made once they're onboarded. They've gone through those AML and KYC checks. They're getting excellent feedback. Experience as well. We'll see that stabilise into the first half of this year. There's always with any platform continual feature developments. We're also focusing on the PayRight integration and making sure that we can have the SaaS license available once we've got it up for all the employers. We can make them talk a little bit to move forward. So stabilising cost base, seeing that capital investment continue, that should into a more what's the next horizon around paid, if you do conditions there that will help us further. So yeah, let me know if any questions. We can answer at the end, but I'll pass back to Trey.
Thank you, Karen. So I want to talk about the numbers and the flow on of customers. So just a couple of things to explain. I know the slide is out there, but the controlled onboarding ran as it should. Just want to give our shareholders some context here. A couple of elements. Number one, although we built data migration in and we've built with the funds, so that was a large investment, as well as tight fraud controls. That has increased our cost, but actually it has made for a much smoother transition. But there are two factors that have been at play. So just so everybody has context here, number one is we put very tight fraud control into the system. As a simple example, you can't take a photo of yourself of a photo of a photo. Our technology can see that and understand it, so we red flag you and block you from being able to come on and make payments. That increased friction, good result, has put us in a very unique field of $0 bid fraud. That's enormous when you consider the amount of advertising, marketing and awareness that went on by the funds to bring people toward either Rest Pay or Aussie Pay or Aussie Solution or the other boutique fund. So while we're really happy with that, we were able to use that control period to now reduce that friction by around 90% without actually increasing any risk. So we continue to monitor. That is one of our highest, our most critical programs, but that's an excellent result, right? But it means you put friction in the system, it slows users down. The other side of that consequence is Australian Super and Rest have had major transformations of their contact centre, taking their contact centres in-house. That means when you put friction, you provide lots of phone calls for them to have to deal with. So they have stabilised how many invites go out to users to ensure that they have the capacity to handle those calls. Now where we sit this week, just to give you an indication, the highest invite list for customers 4 weeks ago would be 10,000 businesses. We now go out to market this week, one of the funds alone, for 46,000 businesses. That gives you an indication of their level of confidence of their ability to bring customers on very, very quickly without unnecessary friction. What did that mean? It really meant we brought customers on at a slower pace than we would have liked. That impacts the total ARPU per user this year because many users will be on for 3 months less than we would have typically liked, so 3 months less transactions. So that's a bit of a background on the controlled ramp. I think it was well balanced. We're really happy with the position that puts us in, but as we now see, the jump has been quite significant, and I'll jump through those numbers a little bit with you. So across the clearinghouse, we've contracted about 4.4 million users across the funds. We also have our own users on top of that that are growing at quite a fast pace, our 600,000. It looks to be close to 700,000 by the time we migrate them on. About 111,000 organisations. Now, we have set a target of ourselves of 250,000 organisations. So where have the months been? At the 20th of each month, so most recent data we can pull for you, had about 6,000 organisations on. They loaded their users, about 1 million users, and then sat quite still. Didn't make any processing. They went through and cleaned their data and got their data ready. 221,000 users, total contributions processed about $100 million. So that's May. Moving into June, 18,000 organisations uploaded themselves onto the system by the 20th. That added about another 590,000 tax file numbers, unique tax file numbers. So actually lots of small businesses in that hump. 404,000 paid their super. So that's ahead of payday super. So not surprising, given small businesses will try and delay, we think, a little bit longer. Then hit June, as at a week ago, we're now 35,000 businesses, 1.9 million, 720,000, and about 1.36 billion in monies that have processed over the clearinghouse. So the ramp up is actually quite significant. We see that total number for the year, just to give you an idea, processing around about $20 billion. So 1.3 at the 20th of the first month, thereabouts. We see that growth rate pretty high. It's stabilising. At the moment, it's about $50 million of transactions every day. In terms of users, and this is the number that really matters, for the last week, we've seen the uptick stabilise at about 30,000 users per day. So that's 30,000 tax file numbers per day. We believe that will maintain at least over the next quarter, but likely drop off as we move to the tail end of customers. To give you an indication, our major funds have now deadlines in place. So the small business clearinghouse that's used by REST and the boutique fund moves to read only at the end of July, so into August. And Australian Super complete their migrations at the end of October. Now, we expect we'll keep the systems live and help support them for an extra month of lag customers. But on the most part, they are driving forward now with ambition because they feel incredibly confident on where they're at in the platform. What does that mean for the revenue? So let's just talk about that. The grey along the bottom here, the 18 million that was achieved last year, of that total revenue, what was ARR, so license-based revenue, is sitting at around $9.9 million. We expect that to go organically. It's already growing. We expect it to finish the year closer to $11 million. So for those who've been around the business for a while, these are our license contracts with the other funds, ART, and so on. ART, Commonwealth Super Corporation, IOOF, as well as the Click Super revenues. The green line is our revenue line because revenue lags our onboarding of members, because our ARPU of $7 takes a full year to achieve. But if we take the bottom line, the brown, the yellow, the brownish colour, that rate is 15,000 users a day. So if we were to maintain 15,000 users a day, the end of this financial year, we would be sitting at around $37 million of total ARR. So that means FY28 starts on a minimum base of 37 million, right, of ARR revenue, because we've really moved out of consulting and lumpy revenues now. Obviously, if we can maintain the 30,000 to 35,000, we will achieve all of our contracts and have ourselves above the 40 million, and our revenue line will be much higher, earlier and ahead of schedule at April. It means we'll have capacity and be hunting for more funds, bring more users on board to the platform. So the numbers that you see in front of you are really the MUFG contract on top of our existing license contracts. So revenue, the green line, does lag the ARR. The ARR is an exit rate. So it's the average of the last 3 months. So annualized revenue, license revenue, built forward. So we get that for forever into the future until these contracts are no longer in place. So actually overall, really healthy position to be in for the company. And I can bring this chart back up when we get to Q&A if that's helpful for people. So one question that was raised, I'll just head off here. Could our revenue be higher in the year? Yeah, absolutely. And that's, we don't have business targets at that line. We are pushing for business targets higher, but we want to set expectations because there are two things here that we don't have visibility of where I sit in front of you today, and that's the quality of users. How many users coming on are weekly and fortnightly versus monthly transaction payers? We won't have full visibility of that until about midway through next month. The second thing that drives variance, obviously, is there is a lag of payment. Traditionally, it's about at the end of the month, we bill, we then get paid 30 days later, although traditionally we've seen payment at the 60-day mark, which means cash is about 90 days beyond hence the green line, beyond the brown line. So that's very much the focus for the year. We feel actually it's an incredibly strong position, which leads into the capital raise conversation. We had quite a lengthy debate in the business around the need for cash or not. And I'll talk to that in a bit of detail just so you can understand the conversations and decisions that we took seriously. So where are we? Effectively, our confidence, we are looking to be incredibly confident when all eyes are on Wrkr. So where are we right now? We are still in a sales process of 4 funds on top of the existing fund. Obviously, 2 outside of MUFG, the 2 obvious candidates within MUFG. We felt that being close to our cash reserves was not the right thing going into that space, and we actually felt it made us vulnerable as a business around payments and payment terms. And we want to be in a position of negotiating strength with our partners and also with our upcoming funds. You know, in effect, we're not in a position where we're negotiating on price because our price discount has been set by Australian Super, bringing the volume they bought to MUFG. So that was really what was important to us. So confidence in front of prospect funds, confidence in front of Australian Super and REF, who are having to make the call to turn off and hard switch from their prior system. So what does that mean? It means no going back. That's really good for our business, but we need to be rock solid for that. But also we've acquired PaidRight. We have assets already in play in paying credentials, but we want to get on with it scaling, and we don't want to be deferring that for 12 months because we know that there is build to be done and the revenue will significantly lag build. So we want FY28 to have all of the growth engines in play. We really felt we had a need to be in that capital position. What that meant was, as you will have all read, we took the decision to go and take a placement of $10 million. We chose a placement on the basis of speed and cost to execute. We didn't want this to be a lag or a distraction on the business. Look, lots of conjecture. I'll talk a little bit about it from a market perspective, but in this market where there is uncertainty around capital gains tax rulings, where we look like we're spending money ahead of the uptake of users and come raise, so look like we're likely to raise, we just felt it was doing damage to share price stability and the interest in our stock. That was certainly one external element. We also felt the markets themselves are quite vulnerable at the moment. We've seen the discussion on SaaS-mageddon. The reality is we use a SaaS pricing model, but we are a regulated transaction-based business. So we're not vulnerable to the concerns of SaaS companies. And also AI, which cannot be used on the data that we use, but actually can be used to fast-track new products and services into market. We see it as a distinct advantage, not a threat. That said, you've got to explain that to a market that is fickle, and we've seen most SaaS companies come down as far as around the 50% mark. That really drove our decision to say, be prudent and be on the front foot. Give you an insight, the debate really came down, to be honest, between ego and commerciality. If we backed my ego, we would run and thread the needle, and we would have managed our cost line, and we would have gone into 27 in a very good position. However, and good advice from the board and good healthy discussion, but to be in a position in November to need to raise, I think it would have been a difficult position for me to look my investors in the eyes and say, we backed my ego as opposed to good common sense. So we made the decision to raise now and be in a healthy position to move forward, and we believe that's going to pay dividends for us. So the final bit is, so we've spoken about the why we're raising, but just where does the money go? Obviously, we're still going to spend very cautiously from here until we can see this current run rate of 30,000 continue. If that continues, then we are free and clear on our core business. But customer onboarding and revenue generation is the number one focus still. Payroll integration, we continue to work in the payroll integration. We had 18 existing from the ClickSuper world that we've been able to migrate, but we've actually gone far deeper with both SAP and with Workday, and we feel that provides us a healthy opportunity. In particular, they serve a lot of customers that are not with our existing funds. The third, obviously, product innovation needs to continue in this business. We want the asset of PaidRight to be yielding dividends. So this is not a well done, you've won super, and that's the end of the value of this company. Super is one segment. We want to be prepared to grow into the other. But working capital is key, and obviously the capital raising cost. So that really is the summary of it. I would say a couple of insights before we jump in. Program's been an amazing success. I won't disclose the numbers, but our fees are a fraction of what has been spent by the major super funds in building out this transformation program to use our software and take ownership of their call centres and their total expense for employers. They are proud, and anyone who's driven past a billboard in Melbourne or Sydney will know it, because you've seen Australian Super advertising it on billboards, which is pretty new. They haven't been in a position to be doing that for a long time. Rest Pay has, we're finding it difficult to beat them on digital marketing right now because they're investing so heavily out there. So, and being successful, which is fantastic for us. So customers are proud, our clients are proud. There was a collective caution as we went through the rollout. We are very confident we're through that. I think the 46,000 invites, the turn-off dates of their existing clearing houses is a clear answer to that. The friction, well, I'm glad we did it. We had to train our software to understand the fraud detection, and now we're still at zero, but with low friction. I think that puts us in very good stead. A fantastic quarter, even though we extended hypercare. So that is a positive for the business. Very strong ramp since July. So that tells us, even though the ATO may not be finding aggressively out there in the market for payday super, there are enough organisations that are making the move. And we should also keep in mind that the concern for an organisation is about cash flow management of paying super early, not the cost of multiple transactions, because that bill is being picked up by the funds because they pay the transaction fee to Wrkr. So management are bullish. We're really excited about where the company is going to. Yet we feel a lot more confident having running the start of the year with about 20 million in the bank, for sure. We think that makes us a stronger partner, particularly as we continue to navigate and work with MUFG on bringing on the last couple of funds. But the opportunities sitting in front of us are excellent right now. So that's where I would leave it for you. But please fire off with questions. We'd love to hear what you're interested in, and we'll, as you know it by now, we'll answer straight. Anything going on or not?
Hey Trent, hi Karen. I've got a few questions, but I'll kick off with
Michael,
one.
are you talking? Hang on, mate. I can't hear you. I've got you muted. 1 second, mate.
Can you hear me now?
Unmute all. I'm going to unmute you all, so you'll have to go one at a time.
How about now? Can you hear me now? No. I can hear. Any luck now? No? Okay.
Sorry, we're using a new
I can go to
form
chat. I'll put,
with Zoom, so
I'll
seems
try and
maybe we're
put,
not great in tech.
Thanks, Karen. Thank you. Thank you. You have muted yourself. Mate. Can you hear us now, Cam? Right. John, what's the outlook for investment spend in FY27 and the associated project? A good question, John. The spend at the moment, we expect about the same profile of capitalisation, but if I keep it really crisp, we've set a ceiling on our cost base. So the cost base, including paid rights, sits at 32 million, while we'll run a small buffer up and down over the year. The net position for the year is forecasting set to remain at 32. If you assume our current revenue run rate, obviously the revenue or cash received will run under that 32 position. We would be obviously wanting to target higher than the 24 mil line that you saw. There is an 8 million roughly expected for capitalisation this year in projects. So that is predominantly geared for these latter projects, and the payroll integration and paid right. So that sets us really in a position we would be expecting EBITDA positive through this year when you take into account capitalisation. But major projects where we have no acquisition planned at this stage, we think we've hit off enough. We want to make sure that we are positive revenue position before any more bolt-on acquisitions. But that said, the investment of pay comes on the same platform, so we don't expect to be adding entire builds. It's fairly small. So the ARR chart, can you comment on where you think the rev might land between the minimum rev base? Yeah, look, I don't want to set the wrong expectations or forecast here. We obviously, everybody likes a line they can jump over. We are targeting though for just below 28, subject to timing. So, you know, for our business, we're engineering towards that. Feel good about that. It could be better if we get much faster take up. We've got the switching over of the inter-fund gateway, which happens in November. If that happens in the correct timing that the current project plan is at, then we'll actually be in better shape. If that's delayed, there'll be a lag on the second leg of transactions. So hence the conservative figure, but we are expecting to go well above that. So circa 2028.
Yeah, I think just adding to that, the conservative position that we're showing on the chart in the green line is the $24 million revenue figure. The dotted lines are really that ARR. It's, you know, we're looking at the ramp up rate at the moment in terms of how many users are being onboarded per day. And we have, you know, depending on how we see that continue or slow down, will really depend on where that exit ARR rate at the end of the year will drive the revenue that we enter into FY28 with. So the longer it takes, the less ARR we build up over the year. The shorter that it takes, I think the signals, the better that ARR.
That second question on the respective CAM, we see a really, in the shorter, so FY28, we see 50 mil being the ARR, so the annualised contracted revenue in the super segment. We can see pay being an equal segment, particularly with the paid right asset, as well as wages, single touch payroll, and other reporting that we have the natural data flows for. It will take longer to build to that 50, but it won't take a large cost base because the core product development will be far, far less than what the super platform has been. Just as an example, complexity in our platform are things like complex org. So when someone like Rosmani Gomez comes on and they have many, many different stores with different ownership of the stores, different payment rights and approvals inside between group ownership versus singular ownership, we've had to accommodate for all of that. It makes our system very, very robust, but when you add wage payment, we don't need to make any changes to those elements. So at that end, we think there is a similar opportunity, but won't be as near a term in the mop-up. I think there will be more M&A to achieve that, the mop-up of credentials. It's a more lucrative segment. We think 50 million is a sensible target. Rule of thumb, each segment in our business only exists as a segment because we believe it is a 50 mil ARR potential segment. So there is enough TAM, there is enough relevance in our product. We'll get faster as we grow those off the same base, but yeah. So hopefully that answers for you, Michael. I'm going to say, Hayden.
Yeah, can you hear me?
There we go, gotcha.
So cash costs are running at 36 mil. So what's coming out if you're saying it's a 32 mil ceiling?
Switching your speakers. Sorry, Hayden, do you mind repeating that question, please?
Yeah, I was just saying cash costs from last quarter was running at 36 mil. So if you're saying we're going to be 32 mil for next year, what's coming out if like CapEx is staying the same?
Yeah, so we've had quite a lot of cost in terms of the data migration piece of work in the year. That's been quite a material component, using subcontractors for that. That will actually save us once that piece has come off around 2.5 million in the year. Additionally, we're pretty much at capacity apart from, and this answers John Burgess's question as well, in terms of resources. In order to scale up the resourcing quite quickly, we did engage recruiters. Obviously, when you've brought on about 40 employees in a year, not all were through recruiters, but we did have quite a high recruitment cost that will come off as well. They're the kind of key material things that are coming off. We're also got some additional resource at the moment around our hypercare. And so we have a team of what we call our Wrkr bees, who are amazing customer success people who are helping with the transition and onboarding our Wrkr Direct and ClickSuper transition customers. And that is a scalable team, which will also come off as the transition progresses. So we've got some key areas of cost savings into FY27.
Program management is the other side, Hayden, as well, where once we're through the actual program implementation, we're into a steady state support. So it's less a high cost programmatic approach and more of a meeting SLAs, reporting on SLAs, which is we've already, because we're operating all the models at the same time, we already have those skills on board. That's been our biggest challenge of running three business models at the same time.
Yeah, okay, sure. One more if you don't mind, and then I'll just hop back into the queue. So I mean, based on those metrics that you gave, even the contributions, it looks like you're running ahead even on that low onboarding outcome, and it's a pretty broad range of outcomes on rev as well. It's probably like 24 to 40 mil. So I guess why go 24 mil given things are still looking like they're ticking up, and what's the 40 mil predicated on?
I think it's important to understand the chart. The dotted lines are ARR exit rate. And so not trying to forecast revenues in the year. It's really looking at what that exit rate is on FY27 based on the different scenarios. The 24 mil green line, solid line is really just managing the expectation around what is the conservative view, just to give our investors and market the position that the business can clearly see ahead of them. without understanding exactly what the onboarding rate will continue at, given that it is somewhat out of our control. The key things that mitigate that obviously are the closure of the SCH online clearinghouse, which is targeted for October, and the turn off and complete switch from Australian Super from their previous clearinghouse in November, latest December. So, you know, there's some mitigants to that, but we really just wanted to make sure that, you know, starting the year, we are talking to everyone about, yes, where is this conservative position, and then having a look at what those different scenarios that we'll see play out, which we'll be able to provide quarterly updates as to how that's tracking as we see the data come in. Yeah.
It's so just conservative, because if I use 37 exit, compare that to 50 exit, like you should book 31 mil in 27, versus 24. So it's not that anything's going wrong, because as I said, it sounds like it's picking up. It's more just, as you said before, just a lack of visibility. So just expectation wise,
Correct.
Is that
Got
Yep.
Yeah, you got it. And look, we're really bullish, but I think in fairness to our investor community and where the share price is at right now, we felt let's set really conservative hurdles and continue to outperform them, and also acknowledge there are some things we just don't have visibility of or control. So as at last week, Australian Super sends out 46,000 invites this week. Anything could pause it by a week or 2 weeks. We want to make sure we're across it. At this stage, they go, and there's no reason to delay, but it's a step we don't control. And I think we just have learnt in dealing with the funds. We also deal with the funds through MUFG at times. So we want to make sure that all of the decisions and all of our confidence is also bakes in what we can't control when some move a little slower than maybe we move as a business. Yeah. John, just to pick up on your one, yes, the 32, and then we take the capitalised investment
As a part of that.
as a part of that. So
I think there's another question there as well. How many FTEs currently, and is this full capacity? We just had a new starter today, actually, who is going to be our payments and data reconciliations manager. Obviously, as the funds scale, that role is very key. We wanted a dedicated resource around that. And that also feeds into our next growth phase around pay. So he'll be working with the product teams and working closely with them about what that strategy looks like as well. I
was going to say, I think the reality is there will be circa another 5 to 6 people we can see as experts that the business, we're stretched and don't have them. But there are other areas in the business where we've now evolved the business quite well and have moved on from. So there'll be a conversation around either repatriation of the right people internally or starting to see some change to that total headcount. We've got at 100 plus people, we've got a couple of people who move on, find the right next stage in their career. We don't automatically replace. We're kind of picking our positions well, and we're very conscious of keeping to that 32 cap line. It's a KPI of the management team. But that said, you'll still see us putting ads out. We still want the best talent we can get in the market. And as we bring on new funds, we've got the capacity right now. So we would shift some of that capacity, obviously, directly into helping onboard those funds. There was a question on the funds. If we just go back, the 4 funds, we obviously are very keen on concluding and bringing on CBUS and Host. That would fulfill the MUFG platform. It's healthy for both our businesses because we then have they are dealing with one technology interface into Aspire. They've had very good feedback from their existing funds. We've had great feedback when we've presented the full solution. But Westpac is in and providing to those 2 right now. So we keep a watch on that. whether they're going to invest heavily in their platform and compete head to head. The reality is their biggest client in Australian Super is now with us. We think that's a pretty fair barometer of what is likely, assuming funds are looking for the same competitive proposition that they sought. So I don't know how to tell you that I feel good about that area. The other funds, we're actually seeing direct reach out. I think we've been in market now long enough to be seen as a trusted provider. There's good feedback and it's a very tight industry. People move around, which is great. So we are getting the net benefit of that now. People who were our clients before popping up in other funds. That said, this next 6 months to 12 months is going to really create a different type of noise, and that is when Australian Super and Rest are growing their default member base because of the quality of software they're putting in front of their clients. That's the test. When they achieve that, we have delivered more than what was ever expected, and also it forces other funds to really look towards us as the model to move to. So I'm not backwards in having those conversations either in the market. Either we're growing more funds or we're helping our current funds grow. They're all users on our platform to me. So that's the brutal truth.
PaidRight, any update on the PaidRight integration as well? Question from Michael.
Yeah, PaidRight going well. Look, we set them a pretty tough task, which was don't let our people destabilise you or vice versa, even though there's enormous excitement about the coming together of the two knowledge sets. We asked them to stick to what we call 4 on 4, so they were 4 mil cost base, 4 million revenue. We felt comfortable enough to part ways with their CEO, who was, had helped navigate through the transition. We achieved those results early. They hit the numbers we wanted, and the team are growing well. That said, that we have already started a project, and this is where AI comes into play. A lot of people are unaware, but the bulk of the market, not just those on Small Business Clearinghouse, there are tens of thousands of businesses not using payrolls in this country who need help, and they need something very simple. Through PaidRight and through our system, we are starting to build out a solution into that space to allow companies to both calculate their pay and do it correctly, but also then generate the SAF file into Wrkr, generate the STP file, generate the payment file into wages, targeting small business, which is a massive sector. But that is the first early area where we've been able to navigate together. And actually, the funds have fed back to us. They're pretty keen on seeing that evolve, because they have a larger customer base than we originally thought in the small business area. But hold your horses on that one in terms of we're not baking in any revenue expectation, but that is where we are doing our building. And yes, we are heavily leveraging AI around the various user interfaces and experience, but not AI around the data itself. We have a built-in AI homegrown model inside PaidRight, which allows us to vet and assess whether someone's paid correctly. So that's been the journey with them. We're trying not to bite off too much and not let them get too excited about that when we still want our 4 million. And they've done that in spades. So we're happy. But this year we move into create new features that will be on the Wrkr platform, and transition out of that 4 million, just change the shape of it. More ARR, less services, more partners. And that's the work being done for this year. So setting expectations again low, but that said, we're pretty excited with the trajectory right now. No other when will PaidRight ARR be visible enough to be reported separate so investors can see? It's on progress. Yeah, so we will, it'll be reported on this year as we go and grow. It'll be wrapped though into the broader pay segment, because there's a merging of some of the products there for the wage payment, back payment and the likes, but you'll get good visibility into that. I did mention in a recent call, the main job is for Wrkr to be driving referrals into PaidRight. Actually, it's already driven 2 referrals into Wrkr, which has been fantastic. So we owe them right now, but they were 2 quite substantive companies that they've opened the door for us for our standard solution, which is excellent. Any comments regarding exposure in Hong Kong? Look, just to maybe close out on a couple of these questions. Look, no exposure, but we're in Hong Kong. We've got some choices to make. We make a reasonable piece of license on Hong Kong. It sits inside that 10 mil ARR. Look, we're going to make a call at some point. Do we get up and grow and really be aggressive in Hong Kong, or just stay behind the scenes supporting MUFG? They've only rolled it out to HSBC. That same solution has several other opportunities we see in the market. Again, I just think the spread we have today is quite large without taking on extra costs. And when you go into another geography, there is no way of avoiding extra costs. You need critical mass of people. So right now, it costs us very little to support with reasonable revenue. We're going to just keep the foot and the eye on that market. I want to win in Australia and conclude the Australian business before we look into the other geographies. I'm really happy with what it contributes. I'll take $500,000 for low to no cost, but I just don't want to go. You've got to invest to grow up there, and we just don't want to at the moment. Good to have the options. What about the future market cap predictions? Couldn't tell you, Luke. We don't predict on future market cap. Look, for what it's worth, I'm incredibly bullish on this business. Joe and I aren't sellers. Those who know me know my aspirations and where I want to take it to. I can see a really clear path. I think we're paying the price for current market conditions and questions on is it real, right? Because we're burning cash without people seeing the revenue. I think as people see the revenue come on this year and the customers come on, I think we go back and upwards from where we were, is my sense. My job now is to make sure that we're sharing that information with everybody, and we're pretty excited that we're actually in a position as at today, we track it daily, and I've got green ticks across the screen. So we are expecting, on a monthly basis, we're in a good, healthy position, and we can see where we're tracking to that graph that you saw before. So I think that's pleasant, because this is not a great newsreel business. It's the add a super fund, they're few and far between. It's about adding the members, and that's what we want to spend the time educating the market on now.
Just got another question here. Any update on gross margin exiting FY27 at your targeted ARR? I mean, regardless of kind of where that ARR is, we're always targeting a gross margin of about 80%. And that's kind of consistent with the industry and what those costs to sell are for a SaaS technology company. So that's where we will continue to target, regardless of where that targeted ARR finishes.
Perfect. So I think that kind of closes us on time. We've recorded it, so I'll definitely put it up. As always, feel free to use our Investor Hub online, fire off questions. We are, I look at the business where it is sitting today. This is, the most confident I have ever been in this business. We're in really good shape. I wish you could come in and take a visit into the offices, and I think our AGM will be based here in the Sydney office, and we'd hopefully people get a chance to just see what's going on in the engine room here, and our investors should be as proud as Australian Super and Rest and the other funds are with the decision to go with Wrkr.